Hello students, welcome to the lecture. And after this lecture, we will be able to learn the following objectives. Explain financial statement analysis, discuss the types of financial analysis, discuss ratio analysis, define the classification of ratio analysis, explain fund flow analysis, discuss cash flow analysis. Financial statement analysis is a common technique that allows small business owners to review their company operational performance. It is the process of examining relationships among financial statement elements and making comparisons with relevant information. It is a valuable tool used by investors and creditors, financial analysts, and others in their decision-making processes related to stocks, bonds, and other financial instruments. Analysts can obtain useful information by comparing a company's most recent financial statements with its results in previous years and with the results of other companies in the same industry. Three primary types of financial statement analysis are commonly known as horizontal analysis, vertical analysis, and ratio analysis. Types of analysis. Horizontal analysis. When an analyst compares financial information for 2 or more years for a single company, the process is referred to as horizontal analysis, since the analyst is reading across the page to compare any single line item, such as sales revenues. Vertical analysis. The term vertical analysis applies because each year's figures are listed vertically on a financial statement. When using vertical analysis, the analyst calculates each item on a single financial statement as a percentage of a total. Ratio analysis. Ratio analysis enables the analyst to compare items on a single financial statement or to examine the relationships between items on 2 financial statements. After calculating ratios for each year's financial data, the analyst can then examine trends for the company across years. Ratio analysis. Ratio analysis is one of the techniques of financial analysis to evaluate the financial condition and performance of a business concern. Simply, ratio means the comparison of one figure to other relevant figure or figures. Advantages and uses of ratio analysis. There are various groups of people who are interested in analysis of financial position of a company. Ratio analysis helps the various groups in the following manner. To work out the profitability. Accounting ratio helps to measure the profitability of the business by calculating the various profitability ratios. To work out the solvency. With the help of solvency ratios, solvency of the company can be measured. Helpful in analysis of financial statement. Ratio analysis helps the outsiders, just like creditors, shareholders, debenture holders, bankers, to know about the profitability and ability of the company to pay them interest and dividend, etc. To simplify the accounting information. Accounting ratios are very useful as they briefly summarize the result of detailed and complicated computations. Limitations of ratio analysis. The following are the main limitations of accounting ratios. Limited comparability. Different firms apply different accounting policies. Therefore, the ratio of one firm cannot always be compared with the ratio of other firm. False results. Accounting ratios are based on data drawn from accounting records. In case that data is correct, then only the ratios will be correct. Effect of price level changes. Price level changes often makes the comparison of figures difficult over a period of time. Changes in price affect the cost of production, sales, and also the value of assets. Qualitative factors are ignored. Ratio analysis is a technique of quantitative analysis and thus ignores qualitative factors which may be important in decision making. costly technique. Ratio analysis is a costly technique and can be used by big business houses. Small business units are not able to afford it. Misleading results. In the absence of absolute data, the result may be misleading. Classification of ratios. Financial ratios are useful indicators of a firm's performance and financial situation. Most ratios can be calculated from information provided by the financial statements. Financial ratios can be classified according to the information they provide. The following types of ratios are frequently used: liquidity ratios, asset turnover ratios, financial leverage ratios, profitability ratios, dividend policy ratios. Liquidity ratios. Liquidity ratios provide information about a firm's ability to meet its short-term financial obligations. Two frequently used liquidity ratios are the current ratio or working capital ratio and the quick ratio. Current ratio. The current ratio is the ratio of current assets to current liabilities. Current ratio is equal to current assets divided by current liabilities. The current ratio is the most basic liquidity test. It signifies a company's ability to meet its short-term liabilities with its short-term assets. Quick ratio. The quick ratio is a tougher test of liquidity than the current ratio. It eliminates certain current assets such as inventory and prepaid expenses that may be more difficult to convert to cash. The quick ratio is defined as follows. The quick ratio is defined as follows. Quick ratio is equal to current assets minus inventory divided by current liabilities. Cash ratio. The cash ratio is the most conservative liquidity ratio of all. It only measures the ability of a firm's cash along with investments that are easily converted into cash to pay its short-term obligations. The cash ratio is defined as follows. Cash ratio is equal to cash plus marketable securities divided by current liabilities. Profitability ratios. Profit margin, return on assets, and return on equity are some examples of profitability ratios. It is important to note that one should understand the company and its business before making decisions that are based solely on ratios. Profit margin analysis. A ratio of profitability calculated as net income divided by revenues or net profits divided by sales. It measures how much out of every dollar of sales a company actually keeps in earnings. Profit margin is very useful when comparing companies in similar industries. Gross margin. Gross margin is simply the amount of each dollar of sales that a company keeps in the form of gross profit, and it is usually stated in percentage terms. Gross margin is equal to gross profit divided by sales. Operating margin. Operating margin captures how much a company makes or loses from its primary business per dollar of sales. Operating margin is equal to operating income or loss divided by sales. Net margin. Net margin considers how much of the company's revenue it keeps when all expenses or other forms of income have been considered regardless of their nature. Net margin is equal to net income or loss divided by sales-free cash flow margin. The free cash flow margin simply measures how much per dollar of revenue management is able to convert into free cash flow. Free cash flow margin is equal to free cash flow divided by sales return on assets, ROA. Return on assets measures a company's ability to turn assets into profit. Return on assets is equal to net income plus after-tax interest expense divided by average total assets. Return on equity, ROE. Return on equity is a straightforward ratio that measures a company's return on its investment by shareholders. Return on equity is equal to net income divided by average shareholders' equity. Financial leverage ratios. A company's leverage relates to how much debt it has on its balance sheet, and it is another measure of financial health. Financial leverage ratios provide an indication of the long-term solvency of the firm. Debt equity. The debt-equity ratio measures how much of the company is financed by its debt holders compared with its owners. Debt equity is equal to short-term debt plus long-term debt divided by total equity. Interest coverage. The interest coverage ratio measures a company's ability to meet its interest obligations with income earned from the firm's primary source of business. Interest coverage is equal to operating income divided by interest expense. Asset turnover ratios. Asset turnover ratios indicate of how efficiently the firm utilizes its assets. Two commonly used asset turnover ratios are receivables turnover and inventory turnover. Receivables turnover. Receivables turnover is an indication of how quickly the firm collects its accounts receivables and is defined as follows. Receivables turnover is equal to annual credit sales divided by accounts receivable. Inventory turnover. It is the cost of goods sold in a time period divided by the average inventory level during that period. Inventory turnover is equal to cost of goods sold divided by average inventory. Total asset turnover. Total asset turnover is a catch-all efficiency ratio that highlights how effective management is at using both short-term and long-term assets. Total asset turnover is equal to revenue divided by average total assets. Dividend policy ratios. Dividend policy ratios provide insight into the dividend policy of the firm and the prospects for future growth. Two commonly used ratios are the dividend yield and payout ratio. A high dividend yield does not necessarily translate into a high future rate of return. It is important to consider the prospects for continuing and increasing the dividend in the future. Dividend yield is equal to dividends per share divided by share price. The dividend payout ratio is helpful in this regard and is defined as follows. Payout ratio is equal to dividends per share divided by earnings per share. Use and limitations of financial ratios. A reference point is needed. To be meaningful, most ratios must be compared to historical values of the same firm, the firm's forecasts, or ratios of similar firms. Most ratios by themselves are not highly meaningful. They should be viewed as indicators with several of them combined to paint a picture of the firm's situation. Year-end values may not be representative. Certain account balances that are used to calculate ratios may increase or decrease at the end of the accounting period because of seasonal factors. Ratios are subject to the limitations of accounting methods. Different accounting choices may result in significantly different ratio values. Fund flows analysis. Fund flow analysis is accomplished by preparing a fund flow statement for evaluating the uses of funds and determining the sources of funds to finance those users. Fund flow analysis is done by studying past fund flows and projecting future fund flows. Fund flow statement. Fund flow statement is a statement which shows the inflow and outflow of funds between two dates of balance sheet. So, in company level business, it is very necessary to prepare fund flow statement to know what the sources are and what are the applications of fund between two dates of balance sheet. Steps for making fund flow statement. Making of statement of changes of working capital. For making of fund flow statement, it is very necessary to make statement of changes of working capital, because net increase in working capital is use of fund and net decrease in working capital is source of fund. If current assets are less than previous year current assets, it means decrease in working capital. Statement showing the fund from operation. Operation means business activity and fund from operation means profit from business activity. So before making fund flow statement, we must make statement showing the fund from operation. Advantages of funds flow statement. Since it gives the figures of cash inflow from operations, it gives much more reliable picture of the results of operations than the usual profit and loss account. Since cash or funds is the basis for carrying on operation, the funds flow statement prepared on an estimated basis for the next period will enable a firm to plan its financial operations properly. The statement for the previous year compared with the budget prepared before the year commenced will show to what extent the resources for the company or the firm were used according to plan, to what extent the utilization was unplanned or not proper. Applications or uses of funds. Funds lost in operations, redemption of preference share capital, redemption of debentures, redemption of debentures, repayment of long-term loans, purchase of long-term loans, non-trading payments, increase in working capital. Limitations of fund flow statement. The fund flow statement is prepared with the help of balance sheet and profit and loss account of the current period, and these statements are based on historical cost. The cash position of the firm is not revealed by fund flow statement. To know the cash position, a cash flow statement has to be prepared. The various activities are not classified as operating activities, investing activities, and financing activities while preparing fund flow statement. Cash flow analysis. Cash flow analysis is the study of the cycle of our business's cash inflows and outflows with the purpose of maintaining an adequate cash flow for our business and to provide the basis for cash flow management. Cash flow analysis involves examining the components of your business that affect cash flow, such as accounts receivable, inventory, accounts payable, and credit terms. The cash flow statement. A typical cash flow statement is divided into three parts: cash from operations, cash from investment, and cash from financing activities. Cash flow statements facilitate decision making by providing a basis for judgments concerning the profitability, financial condition, and financial management of a company. The cash budget. Cash budgets provide much more timely information regarding cash inflows and outflows. Cash budgets provide much more detailed information than cash flow statements. Cash budgets will typically distinguish between cash collections from credit customers and cash collections from cash customers. The cash budget is grounded in the overall projected cash requirements of a company for a given period. Uses of cash flow statement. Cash flow statement gives information regarding sources and application of cash and cash equivalents for a specific period so that it becomes easier to plan investment, operating and financial needs of an enterprise. Cash flow helps to understand liquidity and solvency. Solvency is the ability of the business to pay its current liabilities. Cash flow statement provides information relating to surplus or deficit of cash. A comparison of the cash flow for the previous year with the budgeted figures of the same year will indicate as to what extent the cash resources of the business were generated and applied according to the plan. Cash flow statement explains the reasons for lower and higher cash balance with the firm. Limitations of cash flow statement. Non-cash transactions are ignored. Not a substitute for income statement. Not a test of total financial position. Historical in nature. Summary. Now in the end, let us summarize what we have learnt in this lecture. Financial statement analysis is a common technique that allows small business owners to review their company operational performance. Different firms apply different accounting policies. Therefore, the ratio of one firm is compared with the ratio of other firm. Financial ratios are useful indicators of a firm's performance and financial situation. The biggest difference between each ratio is the type of assets used in the calculation. Short-term creditors prefer a high current ratio since it reduces their risk. Fund flow analysis is accomplished by preparing a fund flow statement for evaluating the uses of funds and determining the sources of funds to finance those users. Cash flow is essentially the movement of money into and out of your business. It is the cycle of cash inflows and cash outflows that determine your business's solvency.